Welcome back to Squawk Box. We are joined by a very special guest this morning. Ray Dalio is at the table. Founder of Bridgewater is here. He joins us for an exclusive interview. And for the first time since he stepped down as co-CIO this fall, we should talk about that as well. But a lot to talk to you about. Nice to see you.
Nice to see you.
So help us try to understand what's happening. We always talk about the economic machine. We've got the Federal Reserve as part of that machine of sorts, at least trying to assess what that machine's going to do. You saw what Jay Powell said yesterday. I think we're all trying to make sense of where we really are.
Okay, well, I mean, these things happen over and over again. We're now in the 12th and a half cycle. You know, these cycles, you know how the cycles work. You're 12 and a half cycles since 1945. 1945 was the New World Order, you know, new monetary system. And you know what happens. So let me take you through it quickly. You get a funky economy, weakness, and so on. So what we had, of course, in 2020 with the combination of COVID, and then also the move from the right to the left. There was a distribution of wealth. And so how did you do that? The government had to send out a bunch of checks.
Yep.
And the Federal Reserve, where did the government get the money from? The Federal Reserve lent it. So we have an imbalance. And, of course, that put a lot of money in the system. You've got the demand. You've got the cycle, classic cycle, right? Stimulation, credit becomes debt. Then you have inflation. Then you have a tightness of monetary policy. And so where are we? So we now in a classic spot where we've got a relatively high real interest rate. Real interest rates went from minus 175 basis points to plus 175 basis points, right? You've got a cash rate that's relatively high. Cash used to be trashy. Cash is pretty attractive now. You've got an inverted yield.
Say that again. You said trash is now more attractive? Cash is trash, is what you used to say.
Yes, cash was negative,
right?
1.5%, 2% real rates. Terrible. Now cash is relatively attractive.
Right.
So it's attractive in relation to bonds. It's actually attractive in relation to stocks. You have the classic movement, of course, as rates go up and money becomes tight. You lose the parts of the economy, the parts of the market that are the bubble parts that needed the cash flow, right?
Right.
So you're seeing it reflected in not only, long duration stocks, those that didn't have cash. So you see the tech stocks come down, all of that come down. You see private equity, you see venture capital because they needed cash. All of that comes down. And then, so you're seeing a very, 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 very classic that we've seen these things for 12, we're halfway through a 12 or 13th cycle, right? But what's also happening in that cycle, since 1945, is that we then have the accumulation of a lot of debt and money. Okay, so we deal with things like the debt ceiling. Does the debt ceiling matter? Does it matter how much debt we have? And then you have a situation where there's used to be a free market supply-demand, but now you've got the Federal Reserve who is now taking it, buying it on the balance sheet, so it's not the supply-demand. So you've got that dynamic very, very classically going. I don't think people are paying enough attention to the big cycle. There are these short-term cycles. Since World War II, they've averaged about 6 or 7 years, plus or minus about 3 years. That's what we're in a classic one of those. But we keep building up the debt. And then there are issues in terms of the issue of the dollar and what's happening in terms of the world and the value of money.